on credit insurance as to how this can help businesses overall. You can also participate in the poll. I would also like to introduce my our esteemed speaker for the day, Mr. Keval Rathod. Keval comes with more than 15 years of experience in consulting corporates on their credit insurance programs. He represents Origin Insurance Broker, with whom we have partnered today to bring you this knowledge sharing session on your table. And Origin is the leading insurance broker in India with the biggest team in house for administration and claims management for credit insurance policies. Before we start the session and I hand over the baton to Keval, I would like to briefly introduce the idea and theme as to why we thought about and chose credit insurance as a topic for discussion today. Commercial credit is a basic element of any business transaction in market economies, but it also exposes companies to late payments and defaults becoming a serious problem. As a solution, trade credit insurance can be a savior. It is an insurance policy and risk management product that covers the payment risk resulting from delivery of goods or services. Especially after the advent of COVID-19, we had seen a lot of SMEs, MSMEs across the country who have been reeling under the impact of COVID-19, facing severe losses because of payment defaults. Payment defaults across the globe are rising, and with them, insolvencies are the forecasting to increase by 26% in 2022. Now, especially why for SME and MSME companies, what we felt is they lack the administrative resources to assess their buyers' risk, to tailor credit terms to reflect these risks, and to monitor payments in order to reduce the cash collection period and minimize the occurrence of payment default. To face the lack of credit management, such enterprises can rely on credit insurance. With this, I hand over the baton to Keval. Keval will run us through the product in length and about the coverages, the claims process. Hi, Keval ji. Very good afternoon.
Thank you, Pranod Mike. Very good afternoon. Very good afternoon to every member who's participating in this session. The intention of Pramod Bhai, insurance manager and Origin, essentially to schedule this webinar for the members is essentially to explain the advantages and the basic requirement of credit insurance in the current business environment, right? So if you feel in India, trade has been going on for decades and business has been smooth. But if you see traditionally in India or anywhere, the business would run on trust. But as with the current dynamic geopolitical changes, the probability of default or probability of running a business only on trust is very scary, right? And people earlier used to do business on LC or advanced terms, which has completely changed, and essentially because of the competition. I represent Origin Insurance Brokers, and we have been doing credit insurance for 22 years. We are technically a credit insurance broking firm, but we specialize or focus only on credit insurance. And the biggest strength of Origin is essentially the servicing the policy. We have a separate team who essentially service the policy. And this is not like the general insurance where it is very easy. Probably you meet once a year and the policy is taken care. Here, there are a lot of technicality, which if not taken care, it's very easy for the insurance company to refuse a claim. And where we step in, all your obligation under the policy are taken care by us. And most importantly, claims, everything is first vetted by us and then only go to the insurance company for processing. In last 6 years, we will process around 185 crores of claim for all our customers put together. And that's why we are very confident on servicing any clients. It can be a small or even a large client. So just to give you a little brief understanding on how credit insurance work or what is the definition. Credit insurance is essentially used to mitigate your non-payment risk. So whenever you have any receivables, which can be a domestic or an export receivables, and a buyer defaults, which can be either willfully or insolvency, credit insurance will make good of that loss. It could be a small, tiny exposure of lakhs or a large exposure of crores. Any and everything can be covered in this policy. So if your non-payment is of course a basic which risk would get covered, but what we also cover when it comes to export risk is political insurance. So if you are selling to a country where, if say Sri Lanka is your you have a buyer in Sri Lanka, and till few months everything was all right, but now suddenly the country is in crisis and they don't have dollars to pay. So currency in convertibility is the basic risk is what we cover. And I'll go in detail whether if you have a project risk, there are risks like nationalization, confiscation. For example, in Myanmar, recently there was a coup and all the projects which were running are now at halt, or there is a contract frustration, they decide to cancel the contract. So all this risk are covered in the policy. With credit insurance, one, of course, whatever risk which is open, which is exposed on credit, is what is covered. But more importantly, it also helps you to grow your business. If you see credit insurance, the basic modality is to essentially cover your non-payment. But with credit insurance, it also helps you to grow your business. This is the only insurance which will enable to grow your business. It helps to take larger exposure on existing customers. More importantly, when you want to penetrate into new regions, new customers, new country, insurance company becomes like an external control team which will help you identify the risk and tell you how good, bad, ugly the risk is, and helps you onboard a customer. The biggest advantage, again, if you talk about efficiency, there are let's divide this non-payment to two category. One is collection. We all know collection has been a problem for every seller, right? Recovery, top customers of course will pay you, but majority of the customers they will always delay. And when you have credit insurance in place, what they do is they become like an external credit team. They will recover. Do they have a collection team? They have a legal team. They become a partner to the whole transaction. They help us recover if need. They help us go legal. And even after putting all these efforts, the money does not come in. They pay the claim. So that's a very strong point when you have some partners who can help you in all the stage of a business, right? So how does it work, right? So in a normal transaction, you have a B2B transaction where something you would have an LC, you would have an advanced transaction, but more importantly, whenever there is a credit, there is a high probability of non-payment. So what we do is we take this, we ask for some basic information from you, go to the insurance company and get a commercial for you. Once the commercials are in place, we show the commercial and say a limit is approved. You have an exposure of 5 crore on a buyer. Insurance company has approved a limit on this buyer. You make a transaction on credit and say your terms of payment 90 days and the buyer does not pay on the due date. Now, insurance company will step in, help you put in recovery efforts. And after you and insurance company both put in efforts and the money does not come in, they pay the claim. So this is big advantage when managing your cash flows, right? So usually what happens is the if you know 80-20 Pareto theory, where 80% of your customer would give you 20% income and 20% of your customer would give you 80% income. But when you have such large exposure with all your customer and one or two customer would default, it'll wipe off your bottom line. With credit insurance, your bottom line is always protected. Say if somebody goes bankrupt, there is a 0% of any recovery. Or if you have proprietor partnership entities, which is majority of the case when you have a distribution network, majority of the buyers are proprietor partner entities. You cannot take even them to bankruptcy court. Only a private limited entity can be taken to a bankruptcy court, NCLT court. But with credit insurance, even if they are absconding, in last 2 years, we have seen cases, we have paid claims in scenarios where somebody had expired, somebody had committed suicide, and absconding, all this situation where claims have already been paid. So with credit insurance, your large exposures are definitely taken care of. And here you not only can cover your top limited or private limited entities, but as I mentioned earlier, you can also cover your proprietor partnership entities, where the number of customers is huge and the collection effort that goes in is enormous, and it's very difficult for an entity to manage the entire collection on their own. With credit insurance, the onus of recovery would shift from you to the insurance company, so the collection is also taken care. And if you have this bad debt managed, if you have this recovery managed, you always have a sufficient cash flow income managed. So if you're doing everything on your own and there is one large bad debt, it'll your cash flow will definitely go for a hit. With credit insurance, in 6 months your claim is paid, so that does not affect your cash flow. And we all know that a lot of times what happens, we don't write off. Most of the Indian entities don't write off. They carry this outstanding for 2, 3, 5 years. If you can just estimate, if you're carrying such a huge outstanding for 3 years, 5 years, the interest that you're paying for that outstanding is so much huge to the banks, right? With credit insurance, that is also taken care. So most importantly, that enables you to grow, import, and if you do any if there are any challenges, they also help you to collect the businesses, collect the outstanding. If there is an opportunity where you have a larger contract term, right? A lot of time would happen that you will say no to such kind of business. With credit insurance, if you have a project business and it is say outside India or in even India, will help you take such larger exposure, which would have a milestone payment. With credit insurance, you there is a lot of increase in appetite, and if the credit period can be 30, 60, 90, 180 or above, everything can be covered, right? And if your DSOs are much maintained, your borrowing power also increasing from bank. And with the new revised guidelines, insurance can be assigned to the bank, or banks or NBC can take a policy. So there is a huge opportunity of borrowing more money even without having a collateral or a security to offer to the bank. We have already started doing transaction where we assign this policy to the banks or NBFC as a loss pay, and there is a huge cash flow which they can be generate. So if you see, there are a lot of trading companies who would not have a lot of capital or asset to give banks as a collateral. Credit insurance act as a collateral and help you borrow more money. So if you see, a lot of times because the customers or the exposure are such high, such huge, we often let go of their opportunity. Or the credit period is such high, we let go of their opportunity. And there are only few large entities who have that appetite and would take the end of exposure. With credit insurance, that also is taken care of because there is someone who's backing you on that kind of risk. So if you see in this chart, there are a lot of asset like land and building where we take insurance, which we are sure, which is tangible, visible, and we be sure that we need to manage and that there is a cover which is taken. Machinery, of course, it's very important, and the bank also insists, and that's why we take insurance. Inventory is also a very important part of the entire asset that we have. And a lot of time we take DNO or key man insurance as a policy. But we always miss on one of the most important insurances, account receivables. We don't see that as an asset, but what we feel that is the most important asset in any business, which needs security, and which, because what happens is we presume that insurance is a cost, and that's why we let go of this insurance. A lot of times we feel that we are not going to have a bad debt ever. Our customers are always going to pay, and because of this oversight, in case of any eventuality, there is a huge loss. I'll give you an example where one of my customer who was into Microsoft software licensing, and they have all the blue chip customer as their client, right? Name all the Tata Group, all the big names, they have their customer. And I've been chasing him for a few years, and he was reluctant, saying that there is no default, all big names, kabhi default hota hi nahi hai. And then they had two huge losses. One was 3 crores, another loss was 3.5 crores. This was Jet Airways and Cox and Kings. Nobody had ever envisaged that such big names also can go down and there would be a default, right? And he then now he realized, now he's after me that I want to cover. But unfortunately, past bad debts cannot be covered. It's only future what we can cover. But if we have a foresight, if we can see that we have such a huge outstanding, and if we cover in case of any default, we would be adequately secured. So as mentioning, we need to secure our receivables, and that's how it's very important. This few points probably would be repetitive. Um, so if you see balance sheet protection, so if you have one significant loss and your profit, as we all know, the profit margins are wafer thin, and one or two large losses, it will not only erode your profit, but it could also erode your net worth, right? And once you have such kind of challenges, banks also will shy away and not lend you, and which will become a big scenario in future. So if you see what we are covering is protect default and insolvency. So protect default is what we should focus on, because in India, insolvency would probably take at least a year or two. Somebody declare itself insolvent on paper. In export market, yes, chapter 7, chapter 11 is very much evident. People can probably in a week's time can file a chapter 7, 11 and declare itself insolvent. But in Indian market takes a lot of time. Indian market, people essentially willfully default, that is protect default. And this willful default can be considered in any situation where the customer does not make payment after due date. Say it consists of a financial default where he does not have money to pay, or he does not have intention to pay, or is absconding, or there is a death of the proprietor partnership, proprietor, or dispute between partners, or is absconding. In all such scenarios, in past, we have already paid claims. So this is all a real possibility, and claims can arise, and we would be more than happy to assist you in that kind of default. So if you see, when you have export receivables and it's in difficult countries or even not slightly difficult countries, there is a probability of currency inconsistency. We had a customer where he had receivables from Qatar, and for a brief period of 2 months, where the country did not have any dollars to pay. Customer had all the intention to make the payment, but the country did not have dollars, and hence they could not pay the money. But fortunately, in 2 months, the country had dollars and they paid. But if let's assume a situation like Pakistan or Sri Lanka or Myanmar, where there is a huge crisis, that becomes a very big challenge on recovering our money. Or it could happen that the country decides to put an embargo, right? They said, everything stop, and they will not able to make payment. Or a bigger challenge is if somebody decides to cancel a contract or decide to nationalize the asset. So this happened with GMR India, where they had done a project, airport project in Maldives, and the government changed and they nationalize the product, and they gave pennies to GMR and put them out of the country. They fought for 5 years in court of law, in international court, and then they got some more money. But if they had insurance, they would have been covered. I would just not name a customer of mine where it's a live example. One of my customer had a power project in Myanmar before the coup happened, and they had already mobilized a lot of assets worth of 15 million, and they had a lot of WIP which was ready to supply. Now the coup happened, and once the coup happened, they canceled all the contract. As of excuse me, as of now, the customer has 17 million of outstanding. Fortunately, they had a political insurance in place, and now we are in the final stage of paying the claim out, because we don't see any changes in Myanmar happening for the near future. So with credit insurance and political insurance in place, all your such challenges can be taken care.
Kevalji, one question here, as in fact, that's a question from one of our clients also regarding the political risk. So, like the other policies wherein there's a clause for US and UN sanctioned countries will not be covered. For example, here I'm talking about a company in India which is into services of export services of software. So whether a country like Afghanistan will be covered and the buyers in Afghanistan.
So if it's a project insurance where it's a long-term product, I can get a London syndicate reinsurer, a London syndicate essentially, to give us a cover. But if it's only supplies of product, then we would have to check with one or two other reinsurer based in Singapore if they can offer cover. Right? Project insurance, I can definitely give you a cover, which
So
I'm
it is
sure.
software services. Sorry, it is software services.
Right, right, right. So we would of course take it offline, but if we can know who's the customer, so that also will give a lot of comfort to the insurance company. But yes, there is a possibility where we can cover Afghanistan too.
Okay, thank you.
So there are a few terms which probably is very important to understand in credit insurance. One is discretion limit. How is this beneficial? What happens is when we have a certain turnover, just an example, let's assume we have a 200 crore turnover. When in 200 crores, we would have a lot of buyers, is probably 200, 300 buyers in the whole kitty. So it is not possible for us all to go to insurance company for an approval of each and every buyer. Neither the insurance company would have a bandwidth. So what they do is they give us something called as discretionary limit, discretionary credit limit, which is your authority or the insured's authority to approve a customer without insurance company consent. Example, 25 lakhs. So if insurance company give you a 25 lakhs of discretionary, any customer up to 25 lakhs is your authority to approve. You can decide if it's good enough, you have a trade experience, or if it's a new customer, you have a good market reference, you decide and go ahead and take an exposure of 25 lakhs. And if there is a claim, insurance company is liable to pay the claim. How you get this discretionary is insurance company will see what kind of internal process you have or do you follow when you approve a customer. If insurance company is comfortable with that process, they grant this discretionary limit and you can take approval, take an exposure on the customer without informing them. Exposure beyond that is where we go to the insurance company for approval. So what happens is usually insurance company would want to write 60% of the exposure, which is usually 30%, 20-30% of your buyers. So rest 60-70% of the buyer are underwritten by you and rest insurance company, right? So major chunk of buyers, you get an authority. You can easily approve them, and large limits is where insurance company will approve. And in both the situation, both are covered in the policy if there is a claim situation. The next point is minimum premium deposit. What happens is at times that we project a number, but it's not always that we are accurate on a number. It's always estimate. So let's assume we had projected 200 crores of turnover. Insurance company gives you always a buffer of 20%. So 80% becomes a minimum premium deposit. So in 200 crores turnover, you're liable to pay a premium of 160 crores. So even if you don't achieve the entire 200, you still have a buffer of 20%. But the advantage is you get the pricing advantage of 200% and not 160%. There are a few segments which are a challenging segment for the insurance company, like gems and jewelry, coal, and wind and solar. So gems and jewelry, because most of the insurance company cannot understand this business, especially diamonds. When the diamonds in and now it's a diamond stud gold jewelry, so they don't understand this business and how the valuation is done. So they will probably shy away from covering this sector. Coal is a very volatile and a very risky business. It has been this always. So insurance company are very selective, or usually they will refuse to quote. And solar and wind energy are current. Uh, the premium is very difficult to ascertain because there is a lot of loss of value while generating this energy, and that's why they're not able to price it accurately, and hence they would shy away from quoting on this segment also. But if you see rest, all the sectors, they would be more than keen to offer a premium. And we jointly with Pramod Bhai have a lot of customers in polymers, master batches. textile, mobile, IT peripherals. You can think of a segment. We have a lot of startups where we have done business, and there is a huge potential any segment that we can see in India, because we know India is going to be a consuming economy for at least next 10, 15 years. So there is a huge potential, and we are able to cover you. To now coming on the pricing of factor. So because this is not a tariff policy, every insurance company will look at this policy differently, risk differently, and price it accordingly. They would ask for some basic data, essentially where you would, when we submit a proposal form, it would have an aging, your losses for last 3 years, your turnover, your project turnover, your top 10 customer details. We submit this basic data, and insurance company would then come back with a pricing. What they also look at is what is your internal control process when you approve a customer, essentially for a DCL buyers. Then they will look at what kind of write-off you had in last 3 years. They also look at what kind of buyer profile you have, and including accumulating all these factors, they give a pricing. And once we have this in place, what we also do, there are 4 reinsurer who drive this policy. We go to all 4 of them, make them compete against each other, and get the best pricing possible. So other factors which also can affect the pricing is what kind of TCL we want. So at times, our DCL limit is X, what is approved by the insurance company, but our requirement is much higher. So that also could affect our pricing. Or if the policy is very bad, for example, agrochemicals is a sector which has been a painful point for the insurance company because of the claim ratio. In last 2-3 years, there have been a significant claims, and that's why insurance company would put in a deductible also in the policy. So that also might affect the pricing when it comes to calculation. And once we are okay with the commercials, we can ask them to underwrite our important 10, 15 customers. And we can tell whatever exposure required. Say we require 5 crores on a customer, 2 crores on a customer, 50 lakhs. We prepare a list and they will evaluate a customer. If the limits are to our expectation, then we give a confirmation. We sign the NBA, we pay the premium, and once the premium is paid, the cover starts. The day the premium paid, the cover start, and all the invoices raised from that day are covered under the policy. And then it's like a standard process. They will probably take a week, 10 days time. They will, once we submit all the documents, they prepare a policy and issue a policy document. There are 2 important obligations in credit insurance. One is declaration of your sales turnover, which is buyer wise, you would have to declare sales. And most important is reporting and overdue. So what happens is, if a customer is defaulting, you get a grace period of 60 days over and above your terms of payment, after which one you would have to stop doing further invoicing and then report the insurance company a non-payment. Once you report a non-payment, insurance company will step in and put in recovery efforts. I'll just show you how in the diagram how it looks. Let's assume your terms of payment are 90 days in the invoice. Any insurance company can give you a maximum of 180 days as terms of payment on a short-term business. When you are project business, the terms of payment can be higher. So let's take 90 days as terms of payment, and you get a grace of 60. So all the invoices which are raised in this 150 days are covered in the policy up to the limit approved. If let's assume that your money has not come in, your first invoice is still unpaid till 150th day, then you would have to stop doing further invoicing. If you see a shipment, the point shipment, which means that on the 150th day, you would have to stop doing further shipment. You then have, say, depending on the insurance company, you have 30, 60 days time to notify the insurance company of a non-payment. When you notify the insurance company of a non-payment, the most important step the insurance company will do is they will blacklist the customer in the system. So nobody else will able to give credit to this customer in the system. Then they will also intimate other insurance company saying that this buyer has defaulted to one of my sellers and they've blacklisted them, and they will request them also to blacklist the system. So if they collectively blacklist the customer, there is a high probability that somebody will, if it's a going concern, they will come on the table, negotiate and pay the money. And say, unfortunately, it does not happen. There is a waiting period which is there in the policy. which starts from the due date. So 180 days is the waiting period. This is essentially for Tata AIG and New India. So it starts from the due date, 180 days, where insurance company will put in efforts. First 90 days are yours, where you 60 days you continue trading. Next 30 days you notify the insurance company of non-payment. Next 90 days is where insurance company will step in, blacklist. If required, they put in debt collection agency who specializes is only recovery in recovering the money, and which all the insurance company use them for their outstanding recoveries. They put in efforts for next 90 days, and then the then the agency will submit a report. And once everything is in order, insurance company, you lodge the claim, submit the documents. Next 30 days, insurance company pays the claim. So I tell you, there is, if you as an individual entity go for recovery, the probability of recovery is much lesser vis-a-vis a financial institute going to a customer and putting pressure of recovery. That's the starting point. And when they have a debt collection agency who are professionally legal guys, they day in and out only do recoveries. The pressure is even higher on buyers to pay. They would never use any manpower, so your name is also intact, and they try and put in recovers. Say after whatever efforts for, so by the absconding or not able to pay, there is no money that can pay you. Insurance company pays a claim. The recovery process does not stop here. We have seen in past where after a year or two, after the claim payment has done, the insurance company has been able to recover the outstanding. So in this policy, the claim is paid around 85 to 90% of the outstanding. But more importantly, if they recover that entire amount, they will share the balance 15%, 10% also with you. So your loss is further reduced or at times gone to zero. Whenever, say, if you have to go legal, say if you had a PDC, you bounce a PDC and file 138, the legal cost and the recovery costs are also reimbursed by the insurance company. So not only they pay the claim, they also reimburse the legal cost. And it's not necessary that you would have to go legal on each and every customer. It's only important when you have a PDC, you would have to file. But in rest of scenarios, insurance company would tell you if it's required. Say if there is no PDC and they feel that if we file, say, summary suit or a civil suit, there would be zero probability of any recovery. And that's why they would probably still talk to them, pursue them to pay the money. And if not, they will pay the claim. There are few exclusions. Haji,
sorry, before we take the exclusion, a couple of questions here. One is, as we speak on credit insurance, I would like you to highlight this is applicable for what kinds of businesses? I mean, manufacturing, services, trading, any specific, or it's applicable for all?
So we have customers who are in manufacturing, in trading. We have customers who are in services. So there is no challenge in what kind of business you have. We can cover on all kind of businesses. And I would insist on this point where I tell you, in the current world, banks are also taking policy, or NBFC are also taking policy. This will also significantly help you to grow your business. When you can onboard a bank or assign this policy to the bank as a loss pay, you can borrow a lot of funds which would be unsecured without any collateral or even without any NOC from your current banks. So cash flow is always a challenge, and especially collateral is always a challenge, where most of the time we don't have collateral, but we are going to grow exponentially. Especially when we're in training business, we would have a very minimal collateral. With credit insurance, that becomes a very easy solution. And this has been used globally, and now it would be used aggressively in India.
My second question, Keval, is if a company has multiple lines of businesses or multiple departments, and if they don't wish to take the whole turnover policy, can they go department wise or product wise? Policies is also possible.
Right. So all this credit insurance company are governed and regulated by IRDA, and they would have to file their policy wording with the regulator. And the regulator has approved only a whole turnover policy. So you cannot choose pick a customer and do a policy, but you have an advantage where you can do a division wise. Say you have multiple division. in a business. So you decide to start with one division, which you feel is little more troublesome than the other two division. Insurance company would be more than happy to start with one division and gradually then replicate to other two business. But as you know, everywhere it's economies of scale. Higher turnover, better the pricing. Say if your company has a 500 crore turnover and you decide to start with one division which is 200 crores turnover, so the pricing would be X for 500 crores. For 200 crores, it would be X plus 5. So if we want the economies, then of course we cover the entire turnover. But if we're sure that we want to start with one division and then probably scale it to the other division, it's definitely possible. But picking customers in that one division, not allowed by IRDA, not possible. But yes, there is an exception where if we are doing discounting with the banks, bank can pick few customers and get it discounted and insured from the banks. The revised guidelines where IRDA allows banks, institutes, NBFCs to be selective and take a policy. It's if only it's bank, yes, definitely possible. But as a seller, you don't have an option to choose being, but yes, division definitely possible.
Okay, thank you.
So if you look at exclusion, there are few exclusion which are important and few exclusion are standard, right? So let's look at if you're making a sales to a subsidiary, which you're sure there is no risk, there is not going to be any challenge. So there is no cover available, cannot be covered. Any interest or debit note cannot be covered in the policy. Government bodies cannot be covered in the policy. Government entities, say if it's ONGC, HPCL, which is incorporated under Companies Act, yes, I can cover them. But if it's a department, say canteen store department, or likes of them cannot be covered in the policy. Or if your limit was approved of 1 crore and you did an exposure of 1.2 crores, so then excess or exposure beyond the approved limit cannot be covered in the policy. Any dissolvement or a fraud done by the employees or the agent cannot be covered in the policy. Or the invoice done before the inception cannot be covered in the policy. More importantly, this two things where we should pay attention. We have given a certain process of evaluation of buyer that's called internal credit process, which is essentially used for DCL buyers. And if there is a default, then they will look at our internal process that we had submitted to the insurance company. If we have followed our process and approved a buyer and there is a claim, insurance company would happily pay the claim. But if we have violated our own internal process, then insurance company will refuse the claim. The most important is dispute. So dispute is any performance dispute is essentially any performance issue by the seller. So if you have a quality issue, I cannot cover them, right? Insurance company would ask you to resolve and then come back to them for a claim. But say a lot of times it happens that the buyer would just say it's a dispute and there is no insurance company will not listen to the buyer just because he says that it's a dispute. Any dispute should be legally enforceable, right? Where there is a trail of evidence documented where he's pointing out that there is a challenge and you acknowledge it and you could not resolve it and that's why he's not paying, right? But if there is no documentary evidence and suddenly after you put a case on him and then they will say there is a dispute, insurance company will not listen to them, they will definitely pay the claim. So this, I think, Pramod bhai wanted to take it up. Pramod, please.
Right. So basically, after the credit, we just wanted to tell that what we go through as a process internally of before the placement of business, we do proper underwriting of the risk with those proposal form. And as specifically, if I talk about credit insurance, the kind of compliances which we spoke about is required by insurance company for a claim to be paid. So we at the back end ensure that all those compliances are in place so that your claim becomes admissible. And so including the claims handling and subsequently the renewal strategies also at the time of renewal. Next slide, please. So Keval, you're muted here.
Yeah, sorry. So these are the insurance company who drive credit insurance in India, but they have a reinsurer who actually support the entire transaction. So we have someone called Atreides, who has HDFC and New India as a fronting partner. We have someone called Kofas, who is with ICICI, IFCO Token, Universal Sompo doing credit insurance. Then we have AIG, who's with Tata AIG, and Score is with SBI. ECDC, which is a government entity, they've been doing credit insurance for donkey's years, 70, 75 years. They've been doing credit insurance, and they are essentially an export promotion council, which we work very closely with them. We are the largest broker to even ECDC. When it comes to export, they are very good at it. But because they have a standard product, the pricing is also standard. Irrespective of what your turnover is, the pricing is standard. A 50 crore guy also will get the same pricing. A 500 or a 5,000 crore guy also will get the same pricing. So there is no distinguishing between exposure. You don't get an economic scale, and there are minimal flexibility under the policy because it is structured such a way. But when it comes to private players, the policy can be structured much better. The solution can be much, much competitive, and collection efforts are even better. So we had experience with both of them, and yes, privates have been a little more smoother, a little more competitive when it comes to issuing policy. There is
One
one more
question, in
query.
fact, sorry. Sorry. Yes, Keval.
There is one more question which says during the tariff there might be new buyers. So what happens is there are a lot of customers which you keep on adding because business is such dynamic business. There you'll keep on adding customers, right? You have decided that insurable turnover will be 200 crores, and you keep on adding 10 customers every month. Insurance company will not charge any additional premium for adding customers because it's a turnover based policy or a declaration based policy. Premium will keep on adjusting every month. So if your turnover is say 100 crores, premium is 10 lakhs, just a number. Every month we'll adjust 85,000, and end of 9th, 10th month we know how much the turnover is achieved. And if we have overachieved, we'll consume the entire premium and call for additional premium. There is something as a concept of minimum premium, which we discussed, that if you don't achieve the entire turnover, you have a 10-20% buffer, which either would be refunded at another policy, or if you insurance company take the premium only at 80%. So of course, Pramod will take this point also, but I'll just give feedback from credit insurance perspective. We have been paying claims from all the insurance companies. There are probably 95-97% of our claims get paid, and few are where we would have already told the insured that this claim would not get paid, right? Where they would have the reason for rejections could be where they have not taken approval done a business, or the invoice was pre-policy inception, or the credit management process was not followed. But at origin, we make sure that we start working on this policy even before the claims comes in. So all your requirements are in place even before you lodge a claim or even before there's a default, right? So all the servicing is done in such a way that if there's a claim, it has to be paid, right? Pramod, you do want to take this?
So before the claims management, there's one more question which I wanted to ask you, Kevin, was especially related to the ECGC thing. So many of our customers will have exposure in domestic market, also in the global market. So whether a single policy, whether for domestic sales and export sales, they'll have to buy two separate covers, or they can be clubbed under one single policy.
Oh, that's a very good question. So what happens is ECC unfortunately can only do exports. They cannot do domestic. And if a seller has an exposure in both domestic and export, we will able to cover both under single policy with a private guy, right? Both would be covered under a single policy. But say if you already have an ECC policy, you can only do a domestic policy with the private guys. And next year we can try and we make sure that your export is also covered in this one policy. The bigger advantage is because in your export policy, the premium would be much higher. Because just one example, which I probably can, which I know and for a fact, is their premium starts for a turnover risk policy. The premium starts at 0.51%, and that's for a A1 country. So A1 country ECC, the country classification is very well defined. There are A1, A2, B1, B2, and the price keeps on increasing as the country classification goes down. And it also depends on your number of days on the transaction. So if it's up to 90 days, there is a pricing. If it's increased above 90 days, there is a different pricing. With private guys, it does not matter. They give you one pricing, looking considering everything at day one, countries, terms, and then does not change irrespective of what your terms of payment are, does not change which country you're doing. Yes, they would have restriction on few countries. Yes, that's there, which ECC would have a much higher advantage where they cover countries which, as of now, the customers who already had a policy and are supplying to Sri Lanka is also covered under ECDC. Still, they are offering cover, which private guys would, the day they come to know there is a challenge, they will cover everything in the past, but future invoice they'll ask us to stop doing. The bigger advantage on the private guys is they would know of a distress much earlier than we would know. There, just giving one example, I had a customer where we had exposure and the insurance company came to us that the rating has gone down. And they said, we are withdrawing the limit. They had a 3.5 crore exposure in the past. Your past exposure is covered. Please don't trade further. The seller was very confident that the guy has one business. He has schools, colleges, university. He's a big guy in North. He will pay us. They continue trade for 1 more year. All the old outstanding got knocked off. So insurance company's liability was zero. These guys had a new 3.5 crore outstanding. And then both the brothers were put behind bars. And now there was no opportunity of any recovery. If they would have listened to the insurance company, the claim would be paid. A 3.5 crore is a very huge amount. Right? So insurance company gets a lot of insight much before that we can think of. There are a lot of figures. If they change, they also understand this with this change in this ratios, in this numbers, the probability of default is much higher. So they give you that alert also.
Thank you, Keval. In fact, here this slide talks about our efficient claims management, which we say is our USP, right from documentation, drafting, negotiation with the insurance companies and settlement with them. It's all our responsibility. It also broadly classifies the various class of business under which we are settling claims. In fact, of our total book size, 12% of our claims are settled in the credit insurance segment. Employee benefits being the leader at 38%. Thanks, Keval. Next slide. And in fact, I would also like to tell all our audiences and participants that the session is open for Q&A session. If they have any questions, they can type it and we'll be happy to take it now as we progress.
And I just saw a question where it's asking if the claim is paid on the past turnover or the future turnover. So what happens is in credit insurance, you would project a turnover for the next 12 months. And advantage of credit insurance is like other insurance, you can start at any point of time because the risk is always open, right? And there is no need to align it to the financial year. It does not give any much benefit. But because the risk is open, you probably, if you decide now that you have an open credit exposure and it is critical that we need to cover, you can start the policy immediately. We just share some data, go to the insurance company in 15, 20 days, we will be able to issue a policy. This happened with me. I met a customer last week. They prepared the data. We went to the insurance company this week on Monday. We got a commercial and the customer probably will pay the premium this week. This is going to be the fastest closure that we had. But in credit insurance, the gestation is very high. We are ready. We have a lot of patience. I and Pramod will keep on pushing you and we'll convert the policy.
Right. So we would be happy to take a few more questions, as in as we, if you have any questions, you can type it here. So we've got one more question which says about. Uh, so normally, this is also a very important question which normally I also get. Normally, most of the businesses are secured about, as you also spoke about that 80-20 concept, wherein 80% of their revenues are coming from their top 20 buyers. And they are more than assured about their old buyers because they've got trading history and they know them, right? And they mostly ask about whether we will be able to cover only the new buyers where they are skeptical about and they don't have a trading history. So is it possible? Uh, you've said even though in the past that in during the presentation that the policy covers you for on an annual turnover basis, but is it possible to segregate between the old buyers and new buyers?
Unfortunately, no, that's not available. What we can do is we can take the policy for top customers. Say your 20% of the customer gives you 80% revenue. So what we can do is we can take top 20% ka policy. That's definitely policy possible. What we can do is we can take a higher datum line or an NQL it's called, and exposure beyond that is what will get covered, and we pay premium only for that 20% cover uh, required, because there are huge exposure. What happens is any entity can manage small losses, right? The balance sheet will manage, it's ready to take that kind of losses. But if there is one large loss, uh, the bottom line, the profit will completely erode, or it might affect our net worth also, and which will affect our borrowing power, right? So yes, large top customers possible, but there is no option of doing a new and an existing customer policy.
Okay, one again very important question, especially in the plight of the recent scenario after Russia's invasion of Ukraine. So whether countries like Russia, Ukraine, and Belarus, if our clients have exposure there, whether we get a cover for these countries and clients in those countries?
So uh, till the thing happened, there was an option or opportunity where we could cover that kind of risk. But once there are sanctions which are in place, for example, Russia is now put the highest sanctioned country. Unfortunately, now there will be no cover available for Russia or any sanctioned country. There is no cover. But before any event happens, before any sanctions in place, uh, all the exposure is available for cover unless there is an event. So past, if there is an event, you're protected for your past losses. Future, anyways, you also would be skeptical taking clean exposure with kind of bias. Another thing is where if you have countries like Bangladesh or a few countries where you going to do business in LC, but as we all know, countries like Bangladesh or other countries have so many banks in their country. A lot of time you would not know the name of the bank also. So there is even a risk on the bank when you take a LC back exposure. I can cover them. A lot of time we have a side business, right, which is called cash again delivery or documents again payment. In that kind of transaction, there is a risk in this transaction also, which we very well cover. And if it's a perishable or a customer is good, what could happen is, or it can be any product, you deliver the goods to the customer's port, and now the customer decides not to pick them up. There are huge losses which get involved. Either you would have to get them back or to sell somebody at discount. A lot of time getting them cleared, re-importing, there's a lot of damage. Everything can be covered. If you sell somebody at discount, say you to sell somebody at discount in that country, so there is a 20% loss. Assuming you give 20% discount and you had some damage you have to pay, insurance company will make good of that loss. 20% damage, 20% discount, and the damage cost. So if you had to do it, sell it to other country, discount plus the transit cost also is covered. Say you had to bring it back in India, and because it was customized or perishable, it is now has a salvage value, and you would have to dump it or sell it through, or there is nothing left. Insurance company will make good of that loss also, and including your transit costs and your damages are also covered in that kind of transaction. So a lot of time what we feel is that if we have a CAD or a LC transaction, we are adequately secure. But we also need to understand that LC, the bank has to be A class or A-rated bank, then only you are adequately covered. Or if you have a side payment, there is always a risk of customer not taking the goods, and you would have to sell it to somebody at discount, or there is a damage charge. Recently, only we had a customer who had done a shipment to the billing was in one country and was shipped to another country. Bill to ship to was two different countries, and then the customer decided not to lift the goods from that, and it was an African country. The bigger challenge was they had to file in court of law to get it approved that they can re-import. It was Kenya. So they took approval of the court, and it took is almost a month they took to give this approval. And now the damage has become 40% of the goods value, and we're going to pay claim for that also.
Right, Keval, in the constant of the time, we will take the last question for the day, and then I would hand it over to Prateek to propose a vote of thanks. So one last question here is there any minimum turnover for this policy, or is there a minimum deductible? There are a couple of questions, in fact, in one itself on deductible and turnover.
So what happens is all the insurance company have a minimum premium, and which is cost per policy. So they would charge anywhere between 8 to 10 lakhs of premium. So we would suggest that anything upwards 15 crores of turnover, 20 crores would make sense, because then it would be economically viable for the customer to take a policy. Right? That's what we that's why and deductible. So deductible is not a standard clause. It changes depending on the risk, depending on the buyer, depending on the business profile. And usually insurance company will not give it unless there are huge past bad debts that might affect. There could be a deductible. And there was one more question where it says that can one policy can be given to a lot of banks? Yes, definitely possible. So what now we can do is, say if you have one policy and you have 100 buyers, and there are 3 banks who are discounting your 10 different buyers. So what you can do is you can carve out 10 names, give an endorsement to one bank, another 10 give to another, and third to another bank, and all three would have a different endorsement covering the customer that they are discounting. So that customer loss would be only paid to them. So you have 3 banks who are lending to you, and all the 3 would have adequate cover for their transactions. So yes, possibly it can be done for 3 banks or multiple banks.
Okay, thanks, Keval. Thanks for your wonderful insights and the kind of experience which you have shared over your years, what you have been able to encompass in yourself. And I hand over to Prateek to propose a vote of thanks. And right, over to you, Prateek.
Thanks, Pramod bhai, for participating together on this event. Thanks, everyone. Have a good day.
Thanks very much, Kevalji. On behalf of insurancemanager.com, and Origin Insurance Broker would surely like to thank you from bottom of my heart for giving your valuable time and participating in this session to understand the credit insurance. I hope this credit insurance would make you understand the risk which can help you to mitigate and have your business grow year over a year. Also would like to answer your any queries which might have left out earlier in the question, or maybe if required, we can have a personal meeting to understand these proposals in length. Once again, very much thank you for your participation, and on behalf of the entire team, we wish you a happy Independence Day well in advance. Thank you very much for your time, sir. Everyone.
Well, thank you so much. Thanks, everyone.
Thanks.